Hello and welcome to the Weekly Forex Outlook at XM.com. This week, dollar traders will keep their eyes on the Fed minutes for clues on the Fed's policy path. In addition, we'll get the decisions from the RBA and the RBNZ. I'm Maria Bashard-Vuz, and joining me to discuss all this is senior market analyst Haralambos Pissouros. So Haralambos, turning to the US first, can you tell us how Trump's tariff announcements have affected the greenback so far? Also, do you think the FOMC minutes due out on Wednesday will confirm hawkish Fed bets? And what's the outlook for the dollar going forward?
Hello, Maria. The greenback started the week on a strong footing after Trump announced 25% tariffs on steel and aluminum imports to the US and signaled his intention for reciprocal tariffs on every nation that imposes duties on the US. Now, as we mentioned in the past, tariffs pose upside risks to inflation, and that's maybe one of the reasons why Fed Chair Powell, while testifying before Congress, reiterated the message that the Fed is in no rush to further lower interest rates. On Wednesday, the US CPI data revealed that inflation was stickier than expected in January, and that's even before any tariff-related impact. So even though the greenback pulled back towards the end of the week, all these developments came on top of a strong NFP report for January, and thus they prompted investors to price in only 30 basis points worth of rate cuts by the Fed this year, which is a more hawkish view than the Fed's own projection of 50 basis points worth of cuts. In other words, traders are fully pricing in only 1/4 point reduction by December. Now, as you said, next week we have the Fed minutes on Wednesday, and traders may be eager to scan the report for clues and hints on how willing policymakers are to reconsider their policy path should upside risks to inflation increase. In my opinion, a hawkish flavor from the minutes could benefit the US dollar and also send treasury yields higher. At the same time, these will hurt equities due to concerns about higher for longer borrowing costs.
Moving over to Australia now, the RBA, at its last meeting in 2024, decided to leave rates unchanged. What data has come out since then? What are we likely to hear from the RBA when it meets on Tuesday? And how might that impact the Aussie?
Yes, at its latest meeting, the RBA decided to leave its cash rate target unchanged at 4.35%, noting that the longer-term inflation expectations have been consistent with the inflation target, and that the board is gaining confidence that inflation is moving sustainably towards their objective. And all this was even before Trump's inauguration and the imposition of tariffs on China, which is Australia's main trading partner. And also that was even before the announcement of steel and aluminum tariffs coming to the US. Steel is made by mixing carbon and iron ore is Australia's top export. Also, aluminum is within Australia's top 20 exporting materials. So Trump's tariff plans may have an impact on the Australian economy. Now, at next week's meeting, the bank is expected to cut rates for the first time in this cycle, and thus investors may be eager to find out how policymakers are planning to move thereafter. Anything suggesting that the RBA may embark on an easing cycle more aggressively than investors are currently anticipating could weigh on the Aussie, while the opposite may be true if officials maintain data independency without providing clear signals about their way forward.
Turning to New Zealand now, the RBNZ has cut interest rates 3 times since August 2024. Can you tell us about the current state of the economy in New Zealand and what policymakers are likely to announce when they meet on Wednesday? Is more pain in store for the New Zealand dollar?
In contrast to the RBA, the RBNZ has already cut interest rates 3 times, with the latest 2 decisions being of 50 basis points worth of reductions. The prior meeting was held on November 27th. And since then, GDP data revealed that the New Zealand economy fell into deep recession in the third quarter, while on top of that, the year-on-year CPI rate for the fourth quarter held at 2.2%, very close to the midpoint of the RBNZ's 1 to 3 target range. What's more, the unemployment rate rose to 5.1% from 4.8%, and the labor cost index slowed to 2.9% year-on-year from 3.4%. All these numbers prompted investors to scale up, to ramp up their rate cut bets. They are currently anticipating 105 basis points worth of rate cuts this year, while they are split on whether the bank should proceed with another 50 basis points reduction at this gathering or slow the pace to 25 basis points. So, another bold move and signals that there is more easing to come could hurt the kiwi, which may continue to underperform even its Australian counterpart.
And finally, is there anything else traders should watch out for next week?
Yes, in the UK, the employment report for December will be released on Tuesday, followed by the all-important CPI data for January on Wednesday. UK retail sales for January and the preliminary UK PMIs for February are scheduled for Friday. So, investors are now pricing in around 55 basis points worth of reductions by the Bank of England this year. But should the CPI data echo the bank's concerns about sticky inflation moving forward, traders may reduce their bets, especially if, following this week's better than expected GDP data, the PMIs point to further improvement in economic activity. This may allow the pound to extend its latest recovery. Friday's agenda includes Eurozone's preliminary PMIs as well, and Japan's national CPI numbers. From Canada, we get the CPI data for January. They come out on Tuesday, and following Friday's better than expected Canadian jobs report for January, traders are assigning around a 55% chance for the Bank of Canada to take the sidelines at the upcoming gathering, which is scheduled for the 12th of March. But this probability could well be shaken on Tuesday when we get the inflation numbers, and because strong numbers could increase the case for a pause by the Bank of Canada, while if we get further cooling in an already cool Canadian inflation, the probability for a rate cut could increase, and thereby the loonie could come under selling interest.
Harlambos, thanks so much. This was the Weekly Forex Outlook here at XM.com.